Let me ask you something. What is the biggest obstacle to you buying your own rental property? If you're like most people, you're going to say that the biggest obstacle is that real estate costs too much money. Unlike stocks or other types of investments, you can't buy a rental property or a flip for a few hundred or even a few $1,000s. Even the cheapest houses in America cost tens of thousands, and most cost hundreds of thousands of dollars. Sure, you can finance the purchase with a bank, but most of the time, the bank will want you to put in 20% or more of the purchase price as a down payment. That means that on a $200,000 purchase, you'd have to come up with at least $40,000 just for the down payment, and there will probably be another $10,000 or more in other closing costs. Not to mention that in order to finance a purchase like that, you need to have really good credit, or the bank won't lend to you even if you have enough money for a down payment. So that's it then? Unless you're already rich and have a high credit score, you can't buy an investment property? Well, actually you can, using something called seller financing. And in this installment of my Chalkboard Real Estate Investing series, I will explain exactly what it is and how investors can use it to buy properties even if they don't have a lot of money in the bank and their credit isn't the best. So let's get right into it. So what is seller financing? It's a financing arrangement in which the seller of a property provides part or all of the financing for the buyer to purchase the property. Instead of the buyer obtaining a traditional mortgage from a bank or other lender, the seller extends a loan to the buyer and acts as the lender. Seller financing can take a few different forms. The seller may offer a mortgage with a fixed interest rate and a set term similar to a traditional bank, or alternatively, the seller may offer a contract for deed, also known as a land contract, which allows the buyer to make payments to the seller over time and eventually take ownership of the property once the contract is paid in full. The reason why seller financing may be significantly more advantageous to a buyer who doesn't have a lot of funds or good credit is because, unlike banks and other professional lenders, sellers aren't bound by any particular set of rules or parameters when it comes to the features and terms of the loan. In fact, every single thing in a seller finance deal is 100% negotiable. Let's say the seller is asking $150,000 for the property they are selling. And let's say that you only have $10,000 total and your credit score is 600. Under these facts, you would not be able to buy this deal with a traditional bank. You don't meet their minimum down payment requirements and you don't meet their minimum credit score requirements. But a private seller doesn't have any specific requirements set in stone. What they do have is a desire to sell the property and make what they are asking for or more on the deal. You could start off the negotiation by offering to buy their property for $150,000 on a 30-year amortized seller finance loan at 4% interest with a $5,000 down payment. And if they agree, great. You just got yourself an awesome financing deal that you otherwise wouldn't have gotten with a bank. But suppose the seller is a little bit more savvy than that and they realize that these terms aren't the greatest for them and they want something better. So you may have to improve your offering terms in order to sweeten the deal for them. Yes, you are limited in what you can offer as a down payment by the fact that you only have $10,000 to invest, but you have all kinds of other terms you can play with here. They include the length of the amortization term, or the length of the payoff term, which doesn't have to be in lockstep with the amortization term and can be a balloon payment at an earlier stage. You also have the interest rate that you can adjust upward to make seller financing more enticing. And you can even offer more than what they're asking for as long as the deal still makes financial sense to you based on the income you can possibly generate from the property. You can also offer the seller additional security for the loan, such as a deed in lieu of foreclosure, which can be held in escrow by their attorney. This deed can later be recorded by their attorney in the event you default and immediately transfer the property back to the seller without the need for going through a lengthy and expensive foreclosure process. You can also put up something else that you already own as collateral, such as your car or other valuable property you own, which will further secure the loan. The point is that there are a lot of ways to massage the seller financing terms to make the deal enticing to the seller while still making it profitable for you. Sure, you may have to accept some crappier terms than what you would otherwise get from a bank if you had 20% to put down and had better credit. But what's better? Getting the deal that will cash flow, though not as much as it would in a perfect world, or getting nothing and sitting on the couch, watching daytime TV and whining about how only the rich get to succeed. You already know which option I would choose. While seller financing is an awesome option, it's actually just one of several different ways that you can get started in real estate as someone who doesn't have a lot of money and doesn't have stellar credit. Take a look at this video I recently posted about other ways to get started in real estate with no money or credit. Tap or click the screen, and I'll see you there.